Banks are open. Rates are coming down. But borrowers aren't showing up. And the Bank of England just confirmed it. Here's what most people don't understand about housing. The first warning isn't the price. It's the pipeline. How many people are applying for mortgages? How many are qualifying? How many deals are actually starting? And in the Bank of England's latest credit conditions survey, lenders reported something concerning. Mortgage demand fell at the end of 2025. And they expect it to fall again in early 2026. Now, this isn't a house price index. This isn't a headline about sold prices. This is the market's plumbing. The bit that tells you what's actually happening before it shows up anywhere else. Fewer people applying. Fewer people qualifying. Fewer deals starting. That's not a crash. But it's the early warning that something's wrong. But here's the contradiction nobody's talking about. Rates are falling. So why isn't demand rising? This is where it gets interesting. The Bank of England cut rates to 3.75% in December. Policymakers are saying rates will likely fall further. On paper, that sounds like relief. Cheaper borrowing. Lower payments. Happy days. But demand is still falling. Why? Because you can make borrowing cheaper. But you can't force people to commit. Especially after years of affordability pressure. Especially when job security feels uncertain. Especially when bills keep rising. Especially when confidence is shot. In plain English? People aren't scared of the rate. They're scared of everything else. The survey also noted that unsecured credit demand is expected to stay flat. Which tells you caution isn't isolated to housing. It's everywhere. People are nervous. And nervous people don't take on massive debts. So who actually feels this first? First-time buyers. And movers who need large new mortgages. Because they're the most sensitive to affordability checks. The most exposed to monthly payment jumps. The most likely to fail lender criteria. When demand weakens, they're the ones who pause first. For existing homeowners, the pressure shows up differently. Not as new purchases. As refinancing behavior. When fixed deals end, people shop around. Adjust terms. Switch lenders. Try to manage payments. And you can see that split in the data. November 2025. Purchase approvals, 64,500. Remortgage approvals, 36,600. One market is trying to buy. The other market is trying to survive. But what does this actually mean for the housing market? Here's where transactions start freezing. Here's how a market can look stable on prices, while feeling completely stuck on the ground. When mortgage demand weakens, transactions thin out first. Fewer buyers in the pipeline. Fewer offers being made. Fewer chains completing. And that's where stress quietly accumulates. Online, you see people describing it. Sellers with properties listed for months. Viewings that don't convert. Price reductions stacking up. Offers that never come. The system looks normal from the outside. The for sale signs are still there. The estate agents are still open. But inside? It's quieter than it should be. Prices might hold for now. But activity is dropping. And eventually, one catches up with the other. For builders and developers, a softer mortgage pipeline changes everything. Slower reservations. More negotiation. More reliance on incentives. We'll pay your stamp duty. Here's a deposit contribution. Free upgrades included. All of that is hidden discounting. Because the buyers who can actually complete are getting harder to find. Meanwhile, banks focus on retaining existing customers. Managing credit risk. Being cautious about new lending. The doors are open. But the hallway is empty. So what should you actually watch for next? Here's what matters. A few things to keep your eye on. First, the next money and credit release from the Bank of England. Does the approvals trend confirm this demand weakness? Or does it stabilize? Second, the UK house price index. Do prices start reflecting what the lending data is showing? Third, whether lenders keep reporting availability rising while demand falls. Because that contradiction, open doors, empty hallway, tells you everything about confidence. One important note. The credit conditions survey was conducted in November and early December. It won't capture anything that changed after that. So treat this as an early signal. Not the final word. So where does that leave us? The Bank of England survey shows mortgage demand falling. Lenders expect it to fall further in early 2026. Rates are coming down. But confidence isn't coming back. First-time buyers are pausing. Existing homeowners are managing refinances. Transactions are thinning out. Builders are leaning on incentives. This isn't a crash. But it's the early warning. The pipeline is drying up. Quietly. Before anyone notices. If you're in the UK, I'd love to know what you're seeing. Are buyers still showing up? Are viewings happening? Is the market moving where you are? Drop a comment. Tell me what's actually happening on the ground. Subscribe for calm, evidence-based breakdowns. No hype. No panic. Just the data that matters. See you in the next one.